Hello and welcome back to Dukascopy TV. I'm Natalie MacDonald. Up next in the studio to discuss the fixed income and FX markets is Fabio Michienzi of BCM Partners. Fabio, thank you very much for coming in today.
Oh, thanks to you. I'm very happy to be back with you.
Okay, so central bank rhetoric has really dominated FX markets this calendar year. Can the same be said for fixed income? How have both of these markets responded in 2013?
Well, it certainly can be said, because central banks have dominated the markets throughout the place. In fact, with the easy monetary policy, they have tried to jumpstart the economy, and they have put an incredible amount of monetary easing. Suffice it to say that the Bank of Japan has had an monthly average purchase of assets of $71 billion. The Federal Reserve, an even more outstanding $85 billion, while the European Central Bank has capped the reference rate twice. Now, if this measure have been more or less successful in jump-starting the economy, they have had a side effect for the investors, and their quest for value have modified their risk-reward profile, and progressively all investors have been accepting an ever-increasing assessment of risk. So nowadays they accept a higher liquidity risk, because securities that were historically very illiquid, they have become liquid thanks to these asset repurchase programs. They have accepted a higher interest rate risks. Imagine Europe. In Europe, a triple C company, so a company which is below the investment grade universe, is only yielding 7.5% nowadays, which is certainly not enough to compensate for any default risk. And then there is a more tricky risk, which is the yield curve risk, because any tapering would immediately bring a steepening of the yield curve with tricky effects for the investors.
I just wanted to stick on central bank action for a moment, and no doubt next year's big driver is going to be the implementation of US Federal Reserve tapering. Now, in terms of FX market response, that really is anyone's game. But what about fixed income, particularly when we consider how little it has been priced in thus far? Or is FI in for a bit of a surprise?
Well, forecasting is very difficult, because it's never a precise science, but it's much more of an alchemic work between organizing the data that are known and try to see through the transparency and the clarity that central banks want to give to the markets. In terms of influence of long-term interest rates, which is the final aim of a central bank, these are very much dependent on the perception the investors have on short-term rate and the added risk premium they want to receive for investing on the longer end of the curve. This is why central banks are now trying to be more transparent in their forward-looking policy, and the Federal Reserve in particular, since we're talking about tapering, is linking the speed and the timing of their intervention to inflation rate and to the unemployment rate. If the Federal Reserve is successful in talking the markets through, then the volatility for the markets will be acceptable, and the markets will be on for a smooth ride. If, on the other hand, the Federal Reserve is unsuccessful, or some glitches come to hinder the process, then volatility will skyrocket with unforeseen consequences for the market themselves.
So before we move on to portfolio allocation, where geographically are you seeing opportunities in both the FX and fixed income markets?
Well, let's start by foreign exchange.
Okay.
In 2013, we've seen a depreciation of the US dollars against most currencies. I think that 2014 may see a reversal of this trend, and this is particularly true because I think that the Federal Reserve will withdraw the monetary stimulus, whilst other central banks will be compelled to maintain the monetary stimulus, be it with conventional or unconventional measures. I'm thinking particularly about the Bank of Japan, and which may make the dollar-yen trade a very interesting one for carry reasons. And I'm also thinking of slowing Asian economies nowadays. So I would say that the US dollars is up for a strong ride in 2014. In the credit market, on the other hand, we have once more to differentiate among the three macro regions which are more interesting for fixed income. One being Japan, the other one the United States, and the last one, of course, Europe. Whilst in Japan I see no added value to invest in, and this has been particularly true in 2013, where investors have been disappointed by the lack of reaction on Japanese government bonds or other securities after the measure implemented by the Bank of Japan, it will continue so. And this is certainly because of the structure of the investments in Japanese securities from institutionals and from particulars in Japan. Now, the US and Europe, on the other hand, I see both of them being very interesting, although with different scopes and time frames. In Europe, we currently have a very steep yield curve, where the short end of the curve bears almost no value. It is very depressed, while the longer ends is very interesting and bears a lot of value. But I believe that throughout the year we will have a flattening of the yield curve, with the longer end going towards the shorter end. And this is for two main reasons. One, we are already seeing, and it's a repricing of peripheral risk. We've seen it with Ireland at the moment. I believe it will continue with other selected peripheral countries. The other reasons being the unconventional measures that the European Central Bank is ready to put through and that has already started announcing. In the US, on the other hand, we talking about tapering, but we never put so much accent on the other problem that may arise in the United States, which is the stalemate on fiscal policy and on debt ceiling, which we have experienced in October, for example, and which will be represented at the beginning of the year. So I believe that in the United States, whilst the short end of the curve bears a lot of value, the longer end may be up for volatility and a rough ride.
Some really interesting comments there. How, Fabio, then would you encourage investors to split their portfolio into 2014 then across these asset classes? Well,
splitting is the right word, because I will never stress enough how important it is for an investor to have a differentiated portfolio. This will help keeping risk down while providing the expected return for the risk one wants to undertake. Now, there is no magic formula, so there is no one portfolio fits all, but it's much rather a discussion with every single investors on how prone they are to take risk and what kind of rewards they want to receive from this risk. Having said that, they have, of course, to differentiate among foreign exchange from fixed income, commodities, equities, and other asset classes. If we concentrate only on the two asset classes that we've been going through today, for the portion allocated to foreign exchange, I would definitely say go long dollars against not only Japanese yen, but also against currencies whose country is highly dependent on foreign direct investment and commodities. On the fixed income side of the portfolio, on the other hand, I would say go long on the longer end of selected security of selected peripheral European countries. And in the US, play the short end of the curve, but also play the volatility for the first 6 months on the longer end of the curve.
Fabio, thank you so much for coming in and sharing your comments today. Thank you.
Thanks to you.
That's all we've got time for, but the Dukascopy TV team will be back shortly with plenty more FX analysis and exclusive interviews for you, so don't go away.